A few notes out this morning as well. We got a note from Bank of America's Michael Hartnett. He says that tech and artificial intelligence are forming a bubble and Fed rate hikes may not be over, with rising bond yields posing a risk. Simeon, you've been sticking around with us. I want to get your thoughts on this as well. We've heard so many mentions over the course of the earnings season about AI. It's been kind of this magical potion, if you will. But is that just brewing a bubble that we are waiting to burst at some point?
Look, tech's been on the rebound. Part of it's AI. Part of it is simply that, of course, tech was down substantially last year. But I don't think the tech side of the equation has that much to do with interest rates. Again, duration is such a funny thing in stocks. But if you're looking on a valuation basis, you have to say that the technology sector is very market cap heavy, and that's a challenging way to consider investing when there are other opportunities that aren't nearly as expensive.
Yeah, and as we talked about, maybe some of those in dividend and other areas. Ironically, one of the hot areas that has not been hot in a long time this year has been things like dividend growth, things like bonds in particular as well. The bond market has been very popular. At the same time, as we try to game out what the Fed is going to do, there's really sharp divergences right now in both not only how different strategists view it, but how different parts of the market view what the Fed is going to do. There's now even a scenario where the Fed could skip raising rates at its next meeting and then raise at the one following that. Like, what are we seeing in the markets, and who's right in all of this?
I always just look at the market and see what it's saying, because that's the poll right there. And earlier this morning we were talking about break-even inflation, and it's down to 2%, not just at 10-year break-evens or 5-year break-evens. Break-even inflation for 1 and 2 year is come down to 2%. That's where the rally came from. That's pretty cool. Now, if you're thinking about how to construct a bond portfolio right now, look, you got to have a little extra shorter duration stuff because we don't know when the Fed's going to cut. But 4% plus in the 1 and 2 year space, you're going to have to reinvest it, but you got to take advantage of some of that. There is, I think, a risk that the longer end does start to rise or at least not fall. So in other words, ultimately some sort of steepening. And that's a challenge to just taking long duration bets. Here's an interesting space, though. Credit looks pretty reasonable. IG spreads are at about 145 basis points. That's long-term average. The thing that a lot of people get wrong, leverage isn't high right now. Leverage is really low. Net debt to EBITDA for the S&P 500 is 1 times. It's 3 times on average. So there's a real opportunity there, but you got to go long to get it. And so there, go ahead.
I'm just going to ask you, I think one of the issues is particularly we're talking mostly to an audience of retail investors, right? You start talking about credit, people are like, what do I even do with that, right? I think it's just traditionally not seen as accessible. Stocks, I understand. Bonds, I understand. Investing in company debt is just this whole other thing, and we have seen people go Treasury Direct, for example, which is very accessible. In other words, this very long-winded way of me asking you, how do people get into credit right now? What's the best way? Is it through ETFs?
It's actually pretty straightforward. There are lots of ETFs that give you easy access to the credit market. We take an interesting take at ProShares, which takes advantage of an interesting opportunity right now. So for us, a way to get exposure to investment-grade credit would be our ETF IGHG. What's different about it is it gives you exposure to bonds, but it hedges the interest rate risk. So you get all that spread, all that attractiveness from having long duration, long-term credit exposure, but you're hedging out the interest rate risk. Here's why it's extra interesting right now. The curve is inverted. The Treasury curve is inverted. You're going to make money on that hedge instead of spending money on it. That's pretty cool. So I snuck in a little extra juice here, but the easy answer is you access credit through ETFs is a great way to do it. We've got a little extra twist on it in this environment. That's pretty cool.
The other thing I'm curious about is when you look at flows this year, you've seen some outflows from equity funds. The biggest surge has been into money market funds, right? Where you have the advantage of getting a little bit of a rate, you have the advantage of liquidity. How long does that continue, that enthusiasm for the sort of the shortest term instruments?
It can't go much longer. You mentioned Treasury Direct. We all bought it last year, and we got our 7, 8, 9%, and now that's cut down to 4. A normal world, a normal Treasury world would have Fed funds at 2 and the 10-year at 4%. So the idea that you can get 5% in money markets is you have reinvestment risk, but that may go on for 6 to 12 months. Now, remember time in the market versus timing the market. It makes no sense to have all your money in money markets because you don't know when the equity market's going to take off. It's already done better than people expected this year. The worst thing you could have did at the bottom of the great financial crisis was to go to cash. You would have never gotten your money back. So yes, in the context of your bond allocation, sure, have extra shorter stuff for a little while, but don't take your mix of stocks and bonds. Don't take all that stocks and put it in money markets. The chance of missing out on a bond market rally, on an equity market rally, are just too big.
ProShares global investment strategist joining us here for the 9 a.m. hour. Thanks so much for joining us on this Friday. Simeon Hyman taking the time to break down a range of topics for us before the weekend. Appreciate it.